Hey guys, welcome to another Ultimate Edge webinar series. This time I'm very pleased to introduce you to a friend of mine. I've known Tom Howell for, gosh, a number of years now, Tom. I can't remember how long. Tom wears a lot of hats, and they include, he's a real estate investor. I think that may have been how we got started with our knowing each other. He's also a tax planner. He's got a blog now on financial planning that he's going to talk to us about. I encourage you to hang in here all the way through this because this is called Tom Howell Unplugged. When Tom and I start talking, you never know where it's going to lead. He always has some good and interesting stuff for us. So Tom, thanks for joining us today. I appreciate it.
Thank you for having me, John.
That was a brief introduction. Tell us a little more about your background, Tom. How did you get started? How taxes, where'd you go down that road, and how real estate you got involved in everything there, please?
So back in the 80s, I actually worked for the Internal Revenue Service. So I was a federal employee for 6 years before deciding that government service wasn't for me. At the same time, I've always been interested in the real estate investing world. I used to stay up late at night and watch Carlton Sheets as he would show us how to make money in real estate. So I've never not had an interest in real estate, but it's come and gone over time. I actually suffered my own crisis in '08 and '09 as everyone else did, and took a few years off. And now in the last year or so, I'm jumping back in with fervor. And what I've learned along the way is ways to protect ourselves financially so we don't have these bumps in the road. And also, I want to teach people the magic that real estate has in getting you to retirement early. And so that was the purpose for my blog. Was there's a lot of financial concepts, the magic of finance, I call it, that people need to understand. They're buying houses and holding on to them longer than they should. They're not buying correctly in terms of trying to get to where they need to get to for retirement. So you could get rich slowly and efficiently with real estate, but I believe if you understand the numbers better, you can get there quicker, faster, better.
Got it. All right, good beginning. So great base to start from. Tom, you're a tax planner for clients as well. So if somebody wanted to come to you and talk about tax planning, you would integrate what you just talked about into that planning with them. Is that correct?
That's correct. And part of the whole equation of getting to wealth sooner is to mitigate how much money we send to the IRS. So we want to use entities, we want to use retirement plans, we want to do everything we can to send less money out of our pants and keep more money in our pants.
I like the in the pants analogy. Absolutely true. Yeah. All right. So you want to start with the entity. So it's a little background. Tom and I had breakfast about maybe 4 months ago. I don't know. And I asked him some questions about tax planning for my own situation. By the time I was done, I had 2 sheets of paper with all kinds of entities drawn out and connecting each other, this, that, and everything else. And it was very interesting, which is what prompted this webinar, to be honest with you. You want to start there, Tom, or do you want to go over to the slides you have and go from there? You just guide us here.
Well, so entity planning is tricky in that everybody is in a different place. So there's no one strategy that is right for everybody. And actually, I'm prohibited from giving strategies to the public without knowing more about the people and their situation. So it really takes the yellow pad, sitting down and making a map of what everybody, where they're at today, where they want to go, what they're trying to protect themselves from. And then we can create the entities that get us the most tax efficient behavior. And at the same time, only lawyers can give you the advice when it comes to asset protection. So we always have to defer to the attorney as well when it comes to those questions beyond tax, the impact of taxes. So our breakfast will last a long time.
That's all fair and good. And we'll leave the right spots here to the right experts. I'm with you there, Tom. But define tax efficiency for me. Like, let's say, for instance, you know my situation somewhat. I'm a self-employed individual. I have W-2. I have a couple of different S-corps that invest in real estate and stuff like that. Let's say I'm doing an inefficient tax planning and I'm just kind of rolling things through as opposed to an efficient tax planning. What's the difference in terms of efficiency? Can you put some numbers on that?
I can. So when you're a wage earner and you're getting a W-2, there's not a lot of wiggle room that we have in what we do. Where we really can see the magic is in creating a business on the side or making someone who's self-employed into the proper entity and then shoveling money into pockets such as health savings accounts, 401ks, writing off medical insurance, doing these things to reduce the income down so that the overall tax hit is less. I think most people have heard this over time, that a W-2 employee pays tax on what's on the above the line number, but a business owner gets to take and pay taxes on that number that's below the line after they deduct all these costs and expenses. The difference would be if you were a self-employed person making $100,000 a year, you would, if you were a sole proprietor, you would pay 15% self-employment tax plus your income tax, which could be $20,000. So now you're paying 35% tax on that $100,000.
Wow. Yeah, that adds up.
If we put that in an S corp and you paid yourself $50,000 salary, you would only pay $7,500 in the Social Security tax. You'd still pay the same income tax, and when we're all done, you would be paying $27,500. We'd save $7,500 just by having an entity. If that
That's
entity,
pretty significant.
it is, and if that entity also funded a 401k to the tune of $35,000, we would reduce your income to $65,000, and now our income tax would be $10,000 cheaper. So we can whittle away at that big number of 35% and get you down into 15, 20, 25%. That leaves more money on the table for investing. Also, when you learn to invest using tax-free vehicles, all this gain that you create over time is tax-free and sheltered until you need it.
Got it. Okay, explain that. Why is the gain tax-free and sheltered, or how do you do that, Tom?
So if we were to do our real estate business primarily in a 401k, every time we buy or sell a house or flip a house or hold it as a rental, all that income comes into the 401k tax-free. When we put that on our personal return, we generally will pay tax on our flip profits or sale profits. If we're properly leveraged, we should be pretty close to neutral on the tax return in terms of income. So we don't pay tax on the year-by-year rental, but we would pay tax on sale. If we do all that in that sheltered 401k, we don't lose that 20, 30, 40% over time. So we compound faster. So then you learn the rule of 72, which is one of those magic numbers of finance.
Yes.
The more money that you have available to roll over to the next year, the faster you get to that large number you need to retire.
Very good. So is there a difference between a Roth and a 401k, Tom?
There's a big difference when it comes to real estate investing. IRAs generally cannot use leverage or debt in which to do their real estate investing. And the magic of real estate is the ability to use leverage to compound your returns. A 401k does not have those limitations. So you could technically buy a house for $1 out of your 401k and leverage 99.9% of the transaction, but keep all the profits tax-free.
And so just for clarity here, Tom, are you saying that when you receive the distribution from the 401k, if set up properly, that's not taxable income at that time?
Well, distribution is different. We're talking about the 401k being the owner of the real estate transaction, and all the profit coming back into the 401k tax-free. When you distribute the money to yourselves, say at retirement, you would then pay tax on that unless you had done some other mitigating things along the way. When you're in control of your own 401k, you can actually make it a Roth 401k. So you could make all future distributions tax-free.
I love it. You want to spend a little time on that, Tom? Or I'm really interested also in getting over to that slide that you showed me earlier too. So which direction you want to go here?
Well, how much more do you want to know about the 401k?
I think you should expound on that a little bit. So how do you make the magic? How do you take the 401k and move it over to the Roth 401k so you avoid taxes coming out? Is there a taxable event when you do that or something?
There's not. There is if there's already money in a 401k. So if you're a self-employed individual and you don't have any employees, it's very easy to do what's called a solo 401k. That solo 401k only allows you, and if you're married, your spouse, to be the owners of the 401k. You could each contribute money into that 401k, and the business can match some portion of that.
Okay.
So it is possible to get as much as $60,000 per person into that 401k each year, remove it from the current year's income so you don't pay tax on it. And then when you learn how to invest with the 401k, because you're now in charge of your own funds, you buy, sell, flip houses in the 401k, and that forever stays tax-free. And immediately you can create a Roth component. However, when you roll money into the Roth, you do pay tax as you do when you roll a regular IRA into a Roth IRA. And I'll tell you this little tidbit. Right now, for the next 4 years, is the best time we've seen in 100 years to roll money out of a Roth. With the Trump tax law changes that we've experienced, this is the lowest individual tax rate we've seen in 100 years. And so that expires in 2023 when the tax rates are expected to go back up to what they were before the Trump tax cuts.
Okay.
The next few years is when you need to roll the money into the Roth. Also, there's some talk out there that the Roth may go away, that Congress may decide that they gave too much away.
Really?
And they will grandfather in the people who had previously established Roths. I would encourage everybody to at least start that Roth, get that 5-year holding period started, even if it's $500. Just get it started so that the account can age and be grandfathered if the law changes.
Without a doubt, that tidbit is worth the price of admission alone, Tom, no doubt. Okay, speaking of which, one of the questions I get asked a lot, Tom, is that with the tax changes recently, how that impacts the deductibility of interest for your owner-occupied residence. Is there a difference now? Is it better or worse? Or where's the demarcation line on that?
So previously, we used to be able to deduct mortgage interest that was used to buy, purchase, and remodel your personal residence up to $1 million. That number was reduced, I believe, to $750,000. And now second mortgages or home equity lines of credit interest may not be deductible unless we can do what's called interest tracing to a deductible event, such as funding a business or investments.
Okay. All right. By chance, if that home equity line of credit is in first position and not second, does that change the rule on the lines of credit?
So the way we actually do this is we take your acquisition debt, which is what you bought the property with, plus any additional debt that you reinvested into the property. So if you took home equity money out and used it to remodel your house, that's considered acquisition debt.
Okay.
That acquisition debt is deductible up to $750,000.
Okay.
Any money you pull out of any mortgage, first, second, or otherwise, that exceeds acquisition debt may or may not be tax deductible based on what you did with it.
I like it. Tom, before we move on to the slides you have, let me just check and see if I have any questions here. So not just yet. Guys, we have a number of participants, Tom, hanging out watching here. So if you have questions, put them in the Q&A or the chat box, either one. And when I see them, I'll ask Tom and he can answer those at that time. Tom, you were showing me that cool slide and talking about leverage and all of that. Shall we move forward into that here?
Okay. Let me bring that up here. So this is part of the conversation around, is it happening?
There it is. We can see it.
You can see it. Okay. So this is one of the things that I think everybody misses out on. They think that when they're giving their money to their 401k at work or to their regular Wall Street broker, that they're going to be increasing their wealth over time. And the break-even formula actually can prove to us that that doesn't happen. And so the break-even formula in finance tells us that we have to take into account inflation. We also have to take into account the drag of taxes on our returns. So this particular slide shows us that if we were experiencing 4% inflation, which I think is pretty reasonable, the government says inflation is running somewhere around 2%.
Right.
However, they don't count fuel and food in their calculations.
Okay.
So I think when we look at those two, which are pretty volatile, 4% is a better number. There are actually websites out there, Shadow Stats is one I quoted, that thinks inflation is actually running 8 or 9%. And when we factor in the rent increases that we see in the Seattle market, when the housing prices are going up 10 and 12 and 14% a year, you could think 8 or 10% appreciation is probably happening out there.
Sure.
In my example, if we have a tax rate of 30%, and we do the math, our break-even calculation, just to be able to buy the same things in the future that we're buying today, we would have to make 5.71% just to stay even.
So you were saying with this formula, Tom, that any return on investment you have for real estate or wherever your funds are at, if it's not making 5.7%, you're losing ground.
You're losing ground. Whether you measure cups of coffee or bags of groceries, and in my example, I showed bags of groceries, you would buy fewer bags of groceries over time if your rate of return is less than 5.71%.
Wow. Okay.
And most stockbrokers will quote 6.5 or 7% returns on their portfolio. So they are only increasing your purchasing power after taxes at 1, 2, 3%. That's not really creating wealth. That's just maintaining status quo. And I'm a big believer in the power of real estate to create wealth, to change where we're at on our scale of living style.
All right, you definitely have our attention here, Tom. So let's move forward. How are we going to create some wealth here? What's the right path for that?
So you need to understand the compounding effect of real estate. When you know how to properly purchase real estate and leverage it correctly, you can get 20, 30, 40% internal rates of return on real estate. And that, you subtract the 5.71% from a 20% return, and now your wealth is growing at 15% a year. That means your net worth, your purchasing power net worth will double every 4 years using the rule of 72. So giving yourself 20 years, you can multiply, say, $100,000 today into $1.2 million, $1.4 million. When you know how to turn that into cash flow, now we're retiring with $12,000, $14,000 a month in cash flow.
Now that's significant. Now, Tom, I want to go forward to that, but before we do, you've mentioned the rule of 72 a few times now. Can you break down what that means for folks who are not familiar with the rule of 72?
I can. So the rule of 72 says that if you take a rate of return into the number of 72, it would tell you how many years it would take to double your money. Conversely, if you want to double your money, you would take how long you want to take to double it into 72, and that tells you the rate of return you'd have to get there.
Yeah. So if you're earning that 15% or so, you just take that into 72, and how many years does that come out to, Tom?
That's going to be a little less than 3 years.
Yep, exactly. So pretty significant.
Very significant. And someone today who's living on $40,000, $50,000, $60,000 a year, let's say 100, the math is easier. When you factor in 6%, 4% inflation over 20 years, you're going to need 180, 200,000 a year to have the same purchasing power that your 100,000 has today. So it sounds scary to think that you're going to need 20,000 a month in retirement in 20 years, but 20, 30, 40 years ago, your parents didn't think they'd need 4,000 or 5,000 a month to live either.
Exactly right.
And the reality is Social Security is only going up on the government's stated cost of living adjustments. And so we are losing purchasing power with Social Security. So assuming nothing changes, in 20 years, Social Security will only buy your groceries. It won't pay your rent.
Those are sobering numbers you're throwing at us here, Tom.
Right. So letting the government be our pension plan doesn't make sense to me. So we want to do whatever we can to build our own wealth. And for those that want to really work hard at getting wealthier than they are today, real estate, I think, is one of the best ways to get there. It's not the only way to get there, but it's one of the best ways.
All right, let's move that one forward then. What's the optimum way or optimal ways, or dive in there, how we should be looking at investing in real estate, what entities and all of that, please.
So real estate should almost always be purchased in an LLC if you're going to hold it for any length of time, and then your attorney can give you the asset protection reasons for that. There's no significant tax advantages to the LLC. It passes through to your personal return. But if you're going to flip properties or do value add, new construction, that type of activity, you would want to be in an S corp so that you can lower the amount of the self-employment tax that you would get on those chunks of money that you make. So it does depend on what style of investing you're going into. Certainly, if you're going to do big plays where you might buy a self-storage center and you're going to syndicate to multiple investors, you would want to use an S corp or an LLC for that, so that everybody can have their own protection.
Okay. You have more slides on this, Tom, or do you want to flip back to the screen where you're showing us your slide?
I have another slide on wealth building, but it's very complicated, probably too hard to explain. I'm trying to simplify that down now.
All right. Well, you know what Tom offered to do, guys. Anybody that wants to, he'll give you his contact information at the end of the webinar, and he will send you that slide. And am I correct, Tom? You're willing to do some free consulting up front with people to see if it makes sense for them to kind of chat with you and walk through that slide with them?
Yeah, I'd love to meet with people. Just sort of do a yellow pad, see where they're at, give them some ideas of where they could go, and then depending on what they want to do, we can talk about going forward after that.
All right. So bring it back to where we can see your smiling face, please, and then you can tell us a little bit more about the right way to invest in real estate here.
Okay.
There you are. Okay. So buying in an entity makes sense. Asset protection. Talk to the attorney about that. You don't get any tax real implications there, kind of thing. What else you want to tell us about?
So one of the things is leverage. There are people out there who promote paying off houses over time. But when you pay off a house, you actually diminish your rate of return pretty low. You actually will underperform the stock market on a free and clear house.
Oh, okay.
So, and the math is pretty simple. If you were renting a house, if you bought a house for $400,000, you were getting $2,500 a month rent, you'd make $30,000 a year. You might pay $10,000 of that in taxes and fees and so forth. The 20 that's left into the 400,000 is 5% return on your money. You know, so putting that 400,000 to work with a stockbroker would get you 6 or 7.
Right.
When you add 60, 70, 80% leverage to that $400,000 house, now we're making, again, 10, 15, 20% returns on our money. Okay,
so explain what you mean when you say we add leverage to it. What are we doing?
We're adding debt. We're getting a mortgage.
Okay, get the mortgage. For any particular loan-to-value calculations you're kind of in favor of, Tom, or what?
Well, and there are actually
cash flow as well. What kind of cash flow do we want to consider there when we get the mortgage?
So, you never want to go negative cash flow. Well, I shouldn't say never. There are situations where I could see creating negative cash flow if you had a more complex structure, but generally you don't want more leverage than the property can support,
right? Fully
loaded with expenses. And then there's a formula in which we can take the risk factor of where the economy is going to measure how much equity we should have. So now that we're at the top of the market and what we see in the next 10 years is at least a slowdown, if not a little bit of a pullback, then you would want to reduce your leverage and keep your leverage more under control going forward from here.
Okay, so you manage it over time as you go, depending on what the future market you expect is going to happen.
Yes.
And where rates are at and all that.
Do it portfolio wide. If you have one house that has an 85% mortgage, get another house at 60% so that the portfolio overall is not over leveraged.
All right, that makes sense. Good. Okay, so you're borrowing money against real estate, the asset, and then you're taking the money, I assume, when you're buying more real estate, Tom, or what's the plan?
Well, buying more real estate is always the plan. What I see, and this is part of what I'm trying to put on my blog, is people hold houses too long. So people that own a house longer than 27 and a half years they lose all their depreciation, which is one of the key components on the tax saving side. Then they pay off their mortgage at 30 years and they still own that house with no leverage, and now their rates of return have sunk way down. The yield curve on real estate actually starts to curve down after about 7, 8, 9 years. So cycling your real estate where you're buying, holding for 8 or 10 years, and then selling and buying 2 or 3 or 4 more, and having an ever-increasing portfolio is what's going to make you wealthy.
All right. So those are 1031 sales. Is that correct when you're doing that?
1031 is a great way to do it if you're not tax sheltered.
Okay.
But I'm also a big fan of not doing a 1031 if it's a personal residence. You can't do it on a personal residence.
Right.
But you know, if you knew how to build expensive homes and live in one for 2 years and walk away with $200,000, $300,000, $400,000 profit tax free every 2 years, that works for some people whose lifestyle can do that.
So explain the tax law there that allows for that, Tom.
So in your principal residence, if you live in it for two or more years, you can actually take $250,000 each. If you're married, that would be $500,000 tax-free from the sale. If you're able to acquire a house at a very low price or build something from scratch and build that margin into it, you could then cash out after 2 years and walk away with all that cash tax-free.
I love it. Let me check some questions here, Tom, before we move on. I know I had some more popped up. Yeah, there's one here. So, Kristen wants to know any tax shelters besides living in the home.
Tax shelters besides living in the home. So I don't generally consider your home a tax shelter. I would consider rental real estate that is, in a perfect world, throwing off monthly cash flow but showing a tax loss after depreciation, the best tax shelter.
All right.
You're actually yielding money, but
speak to us mortgage guys here for a second, Tom, or maybe speak to the clients who say, okay, Tom, you're asking me to buy more real estate, but you're also asking me to minimize my tax consequences, which means I show less income on my tax return. What's the optimum there?
Well, you do have to work with your entire team. And so as a mortgage broker, I would ask someone to call you, John, and say, what's the tax return need to show to keep qualified? So, and this gets into the velocity of money conversation. If you buy a house and then you're stuck for the next 5 or 10 years because you've burned up all your borrowing capacity, you can't buy that second and third property. So maybe buying differently on your houses can get you to keep buying on a regular basis.
Did you say buying differently?
Yes.
Explain this to us.
So I'm a big believer in controlling real estate is as valuable as owning real estate.
Yes.
So if you were able to lease option a house for 5 years and not have to close on it, you actually get to own the future advantages of that piece of real estate without cashing it out, without having to get the mortgage.
Absolutely true.
Right? Knowing how much in reserves you need to hold so that your underwriter is going to approve your loan, making sure that your income is right. If you've over leveraged your rental properties, you won't be able to use that asset as an advantage to get the next mortgage.
Yeah.
Right? You can tell me this, but I believe most underwriters take 25% of the rent right off the top for overhead.
That's exactly right. Yeah.
Right? So if your mortgage payment is more than 75% of your rent, you're actually declining in your ability to borrow the next property.
You're losing ground there. That's exactly right. Yeah. Now, there are other ways to buy without the tax return, guys. We can talk about that if you have questions and you have lots of properties in particular. Those conversations become more relevant. Tom said something really important. Your whole team is really important. He's mentioned an attorney a couple times here. You have a tax advisor. Tom is your man for that. Whoever you're working with on your mortgage side, you want to talk to them if you want to buy more real estate. There's a balancing act that you do here as you acquire real estate. And you got to keep track of your income so you can qualify for more versus the max amount of leverage that Tom is talking about to be able to buy more property kind of thing.
Mm-hmm. I would also encourage people to think bigger and move up.
All right. What's that mean?
Well, certainly buying into larger projects. So if you were to go out and buy a mobile home park, self-storage, all of these classic cash flow vehicles, you can actually get lending that's not tied to your personal tax return. It's tied to the asset, right?
Absolutely.
So if you move into commercial lending and you buy a 10-unit apartment building, that doesn't necessarily require your personal tax return to qualify. It just requires that the building qualify.
Excellent point, Tom.
And a lot of people seem to be afraid of moving up. They like the idea of the small single-family homes. But over time, single-family homes do not produce as well as commercial projects do. That's why all the big money's in commercial projects.
And when you say produce, is that in terms of cash flow that you mean, or appreciation, or both, or what?
Appreciation and cash flow. Generally, cash on cash returns in commercial properties are better than they are on single-family homes. I have a lot of clients who the mortgage payment is barely covered by the incoming rent, and we're not even setting aside rehab costs, vacancy costs, management fees. Properly loaded single-family homes don't perform all that well.
Okay, very, very good. So I want to move this to your blog for a little bit. I know you started a blog, or it's just getting going. Am I correct on that? Tell us about that and what's it's going to be about and how people might go there.
So I call it Passive Income Magic. Part of the journey that I was on, particularly since 2008, is to learn, what I did wrong when I was holding too much land, hoping to develop it. And then when the market turned, I could not cash flow those properties because they were land.
Yeah.
Right? And so it was a scramble to sell them and get them off and do what you had to do to survive. So today it's all about cash flow. Cash is king. I think people need to measure their retirement based on how much cash flow their portfolio can generate, not the net worth that they have. So when you talk to your stockbroker out there, he'll tell you to have 4%. You can live on 4% of your portfolio value. So if you need $100,000 a year, you need $2.5 million in the stock market to be able to live on $100,000 a year. I don't believe you need that much money to make $100,000 a year. I think we could do that on $1 million of net worth. And $1 million of net worth leveraged in real estate is not that hard to do. Does not take longer than 10 or 15 years for most people, particularly in a market like Seattle.
So touch on that for our financial planner part of our audience here. What kind of a balance in the portfolio do you think people should have between real estate and stocks, bonds, depending on where they're at, cash, and so on? Tom, do you have a favorite there?
I don't. And I'm not necessarily partial just to real estate. Anything that produces cash flow can be used in your portfolio. So, but there is a difference between speculation. So when you buy a stock hoping that it goes up, 1,000% in the next couple of years, that's gambling, just like it is if you speculate in Las Vegas. So investing is buying something solid, a blue chip stock or some other mutual fund that's stable and writing it out over time. That's true investing. So you have to look at what assets are out there. There's also this concept called yield stacking, where you put your money in one place, borrow it back out, put it in another place, and actually make 1 or 2% every step of the way as you move the same dollars around. That's a little advanced, but
that's kind of clever, isn't it?
If you've seen the books that say "Bank on Yourself,"
yep.
Have you seen those kind of books?
Absolutely, yeah, sure have.
That's about yield stacking.
Oh,
they don't
have that conversation. I didn't realize that you were a proponent of that. That's good to know.
Yeah, it's a proponent for someone who's heavy in cash.
Right.
It doesn't work well if you're not heavy in cash.
Right. You got to be able to put a lot of cash into that life insurance policy to make it work right.
But again, in retirement, it's a great way to get a compounded rate of return higher than you would otherwise have. And passive real estate, owning 25, 30, 40 rentals is not passive real estate if you're doing your own management.
All right, let me check here. We have another question that came up. Bethany's asking, so if you have income coming in from several syndications, what tax strategies would you employ to reduce the taxes? You want me to read that again, Tom? You got it?
Well, I see that. So if I was holding my syndication interests outside of any tax sheltered account, I would probably want to move it into an S-Corp first. And from that S-Corp, I would want to try to deduct as many legitimate business expenses as I could, shelter it into retirement accounts, and pay myself a salary so that we have basically moved all that money into different pockets in that pair of pants.
Good. Tom, I want to move to your tax planning in just 1 second here, but I don't know if we got closure on the blog. How do people find your blog? Is it up and running? And tell us a little bit more about what you're going to be talking about there.
The blog itself is not running, but I'll share my screen again. I have the front page done so far.
That's a great start. Good start.
People can actually opt into my email list. So I'm in the process of putting together my videos and my graphics so I can explain some of these concepts more easily in small bite-sized pieces. So Passive Income Magic is about to teach you the financial concepts so you can get a better return on your investments, lower your risks overall by spreading your money around to alternative investments, and get you to retirement sooner than you thought you might be otherwise.
Well, that sounds pretty intriguing and interesting to me, for sure.
It is. I find it, the numbers make me, happy. So
that's a great way to put it, Tom. Tom gets happy when he talks about this stuff, no doubt about it.
Yes.
I have the pieces of paper to prove that. So when's the blog going to be up and running, Tom? Do you have any start date for that?
I'm targeting the end of June.
Oh, okay. That's right around the corner.
Mm-hmm.
All right. Well, we'll let Tom give you his contact information at the end, guys, and then you'll be able to plug into that as well. Tom, talks tax planning. You're an active tax planner. Are you seeking clients right now? Where are you at with all of that, please?
Well, I generally will take clients that find me. I don't market very heavily because I am involved in real estate. So I'm beginning my private lending business, as well as trying to move into the syndication world on the bigger projects. But I'm happy to take any tax client that comes along. I have clients all over the country. Almost all of them are involved in real estate one way or the other. So.
Now are you getting full, Tom? Or can you support more people, or where are you at with that?
I can support more people, and I'm willing to hire people to help me support more people.
Okay, very good.
So right now, it's my wife and I doing pretty much everything, but I'm not opposed to hiring people if I get enough interest.
And for our Hawaii clients in particular, Tom, where are you located at right now geographically? And you said took clients all over the country, so that doesn't make much difference?
Doesn't make much difference. I am in north of Seattle in Mukilteo, Washington. But I have clients all over the country, and most people either FedEx me their paperwork or they scan it and upload it to my secure mailbox, and we make it work that way.
All right. Why don't you click your face back on the screen here, Tom, when you can. So, guys, I just want to speak to this because Tom and I have some mutual clients, and it's a really excellent way that I would suggest if you're interested in buying, holding, investing in real estate. I mean, that's what we're about here with Pacific One Mortgage, as you understand, the financing part of that. But you want to do it smart, and you want your team in place. And Tom and I have had more than one conversation with a client on the phone with a conference call to kind of chat about their tax planning and what's optimum use of everything there for them so that they can get the lowest tax amount, shelter as much income as they can, and still move forward and buy real estate if they choose to do so, kind of thing. And that's kind of how it works here with the team approach. Tom, you talked about a lot of things. Let me open it up just for a minute here. Is there anything you haven't shared with us that you want to mention here at the end?
I sometimes have a habit of talking a whole lot more than I should. So
that's why I call it Tom Howell Unplugged. I love it.
And if I don't know something, I usually have an opinion about it. So one or the other,
but
we
it's
have
an
something to talk
opinion,
about.
So it's okay. So we kind of covered things for you. Is that right?
We did.
All right. Well, let's say someone you wanted to get a hold of Tom Howell. What's the best way to do that?
So my email is tom@taxstreet.com.
That was tom@taxstreet.com?
Tax Street, as in Main Street,
taxstreet.com.
And my phone number is 425-954-2460.
Very good. Tom, always a pleasure. I got to get back to this, guys. When Tom and I had breakfast a few months back, and I just want to reference this. I had talked with a couple other tax people about our situation because we were kind of moving toward a different level here in investment. And I said, man, I haven't talked to Tom, because I hadn't gotten a hold of him for a long time. So I offered to buy him breakfast. We sat down. It was an hour later, and I had the yellow pad, 2 sheets of yellow pad, and there's scribbles all over everything. It was possibly, without a doubt, it was the most informative conversation I had. And I talked to 2 or 3 CPAs, Tom, before we got together. One entity, it was an attorney CPA kind of affiliation kind of thing, that charged me $250 for a half-hour conversation on a phone or something like that. Got more out of my breakfast with you than any. Yeah. So it's worthwhile. If you have any tax questions, or Tom talks about a lot of fairly esoteric things here, and as you can tell, a lot of it's really specific to your situation, which is where he's going to go deep, one-on-one with you, kind of thing. Reach out to him. One more time, Tom. Email address, please, and a phone number, please.
Okay, my email is tom@taxstreet.com. The phone number is 425-954-2460.
Perfect. Tom, thanks for the time today spent together. It's always enjoyable for me.
Okay, thank you.